Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, September 8th, and in his latest Big Picture installment, Briefing.com CEO Dick Green takes a look at inflation trends that are getting a lot better. The next two CPI numbers will be negative. The trend after that will drop to about a 2% annual rate unless commodity prices turn higher. This improved inflation outlook, Dick writes, will provide support to the financial markets. CPI will post a decline for August and almost certainly for September as well. The reason is simple: the recent decline in commodity prices and energy in particular. Gasoline prices have already reversed the rise of the past 2 months. The total drop may not come through in the August data, but if not, will continue in the September data. Gasoline prices are not the only energy component in CPI, but prices for the other components have also declined. Natural gas futures prices, for example, have dropped, reversing the price increase for the whole year. This will also help lower energy prices in the CPI. It is not just energy that has created large CPI gains in recent months either. There has also been a surge in food prices. The uptrend in food commodity prices clearly pushed food prices and CPI higher earlier this summer. Now, the recent decline in food commodity prices will ease the pressures on consumer food prices. The core rate of inflation, which is total CPI excluding food and energy, has increased at a faster pace the past 2 months. It had been steady at a trend of 0.2% for many months. In June and July, though, it rose 0.3%. It is our belief that this increase was due to companies pushing through the cost of rising energy inputs to consumers. That should now be over, if not in the August data, then in the September data. Briefing.com forecasts calls for a 0.3% decline in CPI in August and again in September. Variations on these forecasts are possible. The decline in energy prices could be larger in August and smaller in September. Nevertheless, the totals should hold up. So what does this all mean? The stock market is currently obsessed with everything negative. Positive news gets quickly ignored. Yet a couple of months of negative CPI numbers will be hard to ignore. Lower inflation raises the present value of future income streams from earnings, dividends, and bond interest payments. That in turn raises the current value of almost all financial instruments. To read this week's full Big Picture column and our projections for CPI, place your cursor on the Our View tab at the top of the page and select the Big Picture, which is the 4th page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.